All right, what's going on, everybody? It's Josh Answers here with another options trading tutorial. Today I'm going to talk about something very, very basic when it comes to options. So again, we're starting from the beginning of where to start with trading options, and what we're going to talk about is calls versus puts. So if you are trading now, you already know what calls and puts are. So this video isn't going to apply. I'm not going to touch on anything new, so you probably won't even need to watch this. If you are new, if you are looking to get into trading stocks or trading options per se, calls and puts are going to come up no matter what, so you need to know what they are. I will try to keep this as simple as possible. I do believe that there should be an accompanying video to this. We are working on it now, kind of just explaining how an options contract works, how a contract works in general. It would help you understand calls and puts more. However, you could still kind of get a basic understanding without that. So what I want to explain about calls and puts, I just want to show you guys how to find them, how to differentiate between the two, and just help you get that basic fundamental understanding of what a call and put is. And I said this in my last video. Some of these videos, when we're glazing over these topics, they are not fully in depth. So that being said, be cautious, be smart, and don't think watching one of these videos will get you up on it. But it's just to build you a solid foundation. So as far as calls and puts go, in the most simplest sense, when we look at calls and puts, they help differentiate the options contract you are looking to get. So buying a call versus buying a put means two very, very different things. So in the most simplest form, a call means you think the stock is going to go up, and a put means you think the stock is going to go down. So like we said, a better understanding of options contracts and how it works would help give you a better idea. But as you see here, here's your calls, here's your puts. But a call is essentially the right to buy. You're buying a contract that gives you the right to buy a certain stock at a certain price, whereas a put gives you the right to sell. So one's the right to buy, one's the right to sell. So put side means, that you get the right to sell your stock at a specific price. So if you say your stock is going to go down and it goes down, you get that contract and you could guarantee to sell your stock to somebody at a specific price, even if the stock is trading lower than that. So it goes both ways, but again, in essence, a call means you think the stock is going up. A put means you think the stock is going down. That is just the simplest way to put it. But they are a little bit more now. They go in depth. We'll talk about this in other videos as far as long calls, long puts, shorting them. But for the most part, if you're long a call, you think that the stock is going to go up. If you are long a put, you think the stock is going down. So if you short a put or you short a call, then what we just talked about would change 120%. So that's that. And when you guys are looking, not only did I just want to give you guys the definition, but I just wanted to show you guys how to spot them. Because when you go to buy an option, here's the options chain. This is what people call an options chain. This whole order thing, you enter in the ticker of the company, Apple. It gives you all the different dates, and then the strike prices, and again, right here, calls versus puts. So traditionally, almost everywhere, you're going to see calls usually on the left side and puts on the right side. So there's that. I wanted to show you guys that. Here's on eTrade.com. If you are opening the options chain through eTrade, this is exactly how it will look too. Again, you can pick your dates from up here. Strike price, calls on left side, puts on the right side, and then the strike price is in the middle. So how you would read that, pretty much like right here is a 117 strike price, and I will make a video going over what strike price is. 117 strike price, these are the calls. So if you bought this, you would be buying a call. If you bought it on this side, you'd be buying a put. So 177 call means you think the stock is going to go up. 177 put means the stock is where you think it's going to, or is if you think the stock is going to go down. So calls and puts, I'll even show you on Thinkorswim. Here's Thinkorswim, TD Ameritrade. Here's their options chain and how do you go to it. But again, it says it up here, calls, puts, same format, December 16th. Here's your strike price. Here's your calls. Here's your puts. So that's why I want to show you them, just so you guys know what you're looking at when you get them, and so you don't get confused, because each one means something completely different. And I want you guys to understand this too, because I will make another video explaining how to calculate your profits and make sure you're not losing money when you're trading. Because although you get the strike price, although a call may say that you think the stock is going to go up, just because the stock goes up doesn't mean you'll make money on every call. There's a pretty unique formula to how options gain value like that, which is what we'll discuss. But it's it goes beyond that. That's where we're going to talk about break even. It's going to have to factor in with what you pay for the option, how much you pay for it. But in a nutshell, essentially, a call is specifically, wrapping this, putting this all in one. A call is saying, hey, you're going to sell me this stock at this price, or you're going to buy my stock at this price. So whether you think it's going to go up or down depends on really how much you paid for that option, and we're going to get into that. But at the very basics, understanding an options contract, whenever you hear the term call, understand it's more of a bullish bet, and when you hear the term put, it's more of a bearish bet. However, it is still describing the same contract, because two people still have to engage in the contract. And again, this is something I want to discuss more, which I'll make a separate video. But so sorry for getting my ahead of myself on that. But it's still a contract. There's still two people. I guess the best example I could give, it's like when you rent a house. Landlord and tenant will sign the same contract, but the rights and the obligations and the roles of each person changes depending on who they are. The landlord has different rights and obligations than does the tenant, and that's kind of what a call and a put is. It's call and a put is separating you and saying, okay, in this case I'm the tenant, in this case I am the landlord. So I guess that's a good way to explain it without going too crazy. But anyways, that's very, very simple. Again, this is just call and puts at the basics. If you guys do have any questions, feel free to hit me up and we could clarify on this more and go in detail, or just stay subscribed, stay tuned to watch the rest of these videos that I'm kind of alluding to, and just be able to build your foundation from there. Anyways, love you guys. Hope this helped. Subscribe, share the video, like it, stay cool.